Jim Musgrave, and I want to welcome you to Women's Retirement Roadmap. So I gave this webinar live last night to a full house, and my challenge was I had so much information to cover that I went about 45 minutes over my allotted time. So I'm actually re-recording this webinar tonight, and I'm going to keep it under an hour, I promise. So if you attended the workshop last night and things are slightly different, again, I'm covering the same material. It's just I'm going to try to keep it underneath the hour allotted time. So I want to get right to the presentation. So just a couple things with disclosures. Again, this presentation is designed just to provide general information on the subjects I'm going to cover. Again, I'm not providing any specific legal advice or tax advice or investment advice. I'm just kind of bringing up overall topics. Now, again, if you have any specific questions and need consultation on specifically with taxes or legal things, you want to consult your tax advisor as well as your attorney. So just a little bit about me. Again, my name is Jim Musgrave. I'm a comprehensive financial advisor who specializes in retirement income planning. So I've been in the business for over 21 years. And so again, the areas that I work in is primarily, we manage a lot of money. I do a lot of retirement income planning. I set up 401k plans for companies. And really what kind of differentiates me in a couple of other things is that I'm also a fiduciary, which means that I put your needs before mine. Everything's driven by you. And everything that I mentioned with my clients is in your best interest. And the other thing too is on the side is that I'm very passionate about giving back to my community. So I'm involved with a nonprofit called the Society for Financial Awareness, where we go out in the community and teach financial education. So most of my workshops are mostly in Montgomery County, Maryland, as well as Northern Virginia. But now since COVID, we're doing a lot of virtual kind of webinars at this point. So again, you can visit my website, jimmusgrave.com, to learn a little bit more about me. And so I'll just kind of move on from here. Okay, so tonight, man, we got a lot to cover. So one thing I want to talk about are retirement realities and some of the risks that must be addressed when retirement planning. Again, we've got a wide range of people in this area who are doing very, very well financially, and some who are not doing so well financially. So we're going to kind of talk about some of the retirement realities for all different types of demographics. Other thing is that we're going to talk a lot about Social Security. I actually give Social Security webinars very frequently. My next one is going to be October the 6th and 8th. If you have some interest in attending that, I can certainly send you an invitation. So we're going to talk about just a couple little items within Social Security, specifically related to some of the issues that many women have to kind of go through. Other thing is that we're going to talk about withdrawal strategies. Okay, so once you transfer from or transition from the accumulation phase to the distribution phase, how are you going to pull money out of your accounts to make sure that you don't run out of money and you can maintain your standard of living? So we're going to talk about 3 different withdrawal strategies in this presentation. We're also going to show you how to kind of manage your portfolio in bear markets and not run out of money. So that's an important thing. You got to make sure that your money lasts, especially in retirement. Another thing I'm going to briefly kind of talk on taxes and kind of where we think taxes are going and some of the things you have to think about in the distribution phase of taking money out of your qualified plans. And also another big one, we can't do a retirement workshop without talking about rising costs of healthcare and long-term care. So I'm just going to go over a couple points on that too that'll really be helpful to with you in that area. So, and a couple things too is that there are a couple books that I highly recommend. One is called The Safety First Retirement Planning by Wade Pfau. You're going to see the name Wade Pfau a lot if you start to kind of look into various retirement-related research. Wade is one of those academics who's done many different research papers and written multiple books, and he's an academic. And so he's got a great book called The Safety First Retirement Planning, where some of the concepts I'm going to talk about tonight have kind of come from that book and his teachings. The other one's called The Personal Economic Model by Don Blanton. And this is a great short read, but it's one of the best books that I've seen that actually talk about many different aspects of just finances. So I highly recommend Personal Economic Model by Don Blanton. Okay, so Most of you on the call are going to be kind of nearing retirement. And so when you think about preparing for retirement, it's very similar to climbing Mount Everest. Okay, it's a long hike. It doesn't go in one direction. There's dangers along the way. But most of the people think when they think about retirement planning or let's say planning a trip up to Mount Everest or even a smaller mountain, they think about the trip up to the mountain and what needs to happen at that point. So once you reach the top of the mountain, what you realize is that you're only halfway done with your trip. You're only halfway there. So in the accumulation phase relating to retirement planning, that's hiking up the mountain. Hiking down the mountain is in the distribution phase where you have to kind of get down to home base. And unfortunately, not everybody makes it down alive when you're climbing Mount Everest. So when you actually look at statistically about the people who have quite frankly died trying to climb Mount Everest, it's typically on the way down. So related to retirement planning, that's kind of the same similar thing that happens. We want to make sure that when you make that transition into retirement, that you've got consistent income and that you can maintain your standard of living and that you can handle the different curveballs that life is going to throw you in retirement. So that's really what we want to do. We're going to be focusing on the trip down from Mount Everest versus the trip up. Okay, so that's an important concept. And there's just a good kind of visual right there is that in retirement, it's the distribution phase that we're going to focus on. Okay, so just a few little statistics about just kind of women in general and saving statistics. So again, the question is, will more women or men age 65 plus end up in poverty? Well, the answer is that women 65 plus are 80% more likely to be impoverished than men of the same age. Okay, so we don't like those numbers. We got to improve those numbers. What's the cost of women's versus men's retirement health care for those 65 plus? Well, the answer is that women need about $150,000 opposed to men who need roughly $135,000. Again, these are average numbers, but again, women tend to live a little longer than men and need a little bit more, out-of-pocket costs with healthcare costs. Again, who saves more for retirement, men or women? Well, again, women save about 43% less for retirement than men on average. So again, these are just realities that, again, many women have to face when kind of facing retirement planning. So when you look about longevity, one thing I always ask in my seminars is that are you more concerned about living too long or dying too soon? On a personal basis, I'm more concerned about living too long and outliving my assets than dying too soon. So if you look at the longevity on average, men live to on average age 77, women age 82. So if you look at the statistics, again, for a 65-year-old's life expectancy, 1 in 4 will live beyond age 90 and 1 in 10 will live beyond age 95. So when we actually put together retirement income plans for our clients, we want to make sure that the plan is good to at least age 95 or 100 or beyond. Again, I want to make sure that the plan is solid beyond life expectancy, not up to life expectancy. Okay, hopefully that makes sense. So the longevity is one of the bigger risks in retirement that you have to address. And I'm going to kind of talk about how to address that longevity risk in just a few minutes. Okay, and just a couple of statistics. Again, 61% of women will be responsible for their financial retirement. So I want to kind of think about if you are married right now. Again, I know all people on this webinar are not married, but let's say you are married. So what happens if your spouse dies? Okay, so if you're married, you're most likely filing your taxes joint versus single. And so if one spouse dies, the chances are that you're going to go into a higher tax bracket because that's just kind of where the brackets lie in terms of single versus joint. The thresholds are at a different place. So there's a chance that you may be in a high tax bracket. Okay. The second thing is that if you and your spouse are taking Social Security and one spouse dies, okay, the surviving spouse has the option to take the greater of theirs or their deceased spouses. You can't do both. You can't take both your deceased spouse and yours. You can only take one. So what that effectively means is that your Social Security may bump up a little bit if it's less than your deceased spouse's, but it also means that the person with the lower Social Security, that money is going away. That could be 20, 30, $40,000 that's just gone. So you got to think about that upon death, then only one Social Security check is going to come in. The other thing is that you may or may not have a pension. Your spouse may or may not have a pension. But if they do have a pension, I see many times that, especially with military people for some reason, who kind of have the option to kind of take that sooner, that they'll choose the pension with the basic annuity or no survivor option. So remember, if you take a pension and take the single option and not the survivor option, it will give you the most amount that you can receive in retirement. But again, upon death, it stops. So if that's the case in your family where your spouse took a pension, but there's no survivor option, that could be tens of thousands of dollars that's going to go away at that period, in that situation. The other thing is that you and your spouse may or may not have permanent life insurance. So if you do have a pension and you don't have a survivor option, one thing that's very important is to make sure that you have permanent life insurance on the person with that pension. So upon their death, the survivor would have a tax-free death benefit from the life insurance to kind of offset that future income that's now no longer going to come in. So having permanent life insurance is a very important component of retirement planning, especially if there's a spouse, especially if you have a pension with no survivor option. So again, these are kind of the things that you have to kind of be thinking about, when you're doing retirement planning. Okay, so when we put together a retirement plan and we have this conversation, in the back of my mind, we have to be thinking about the different risks that we have to address. So one is that I kind of mentioned is about longevity. Again, the risk of outliving your money or your money not being able to keep up with your living expenses. So if you have Social Security, for example, and it's providing, I'll make it up, a third of your income, and you have the other 2/3 of your income coming from your portfolio, and your portfolio is kind of dwindling down, and you're getting to a point where you can't take out the withdrawals that you have in the past because you're going to literally run out of money, that's a problem. So again, longevity is a huge issue. The other thing is about market risk. We're going to talk a lot about that tonight. And so, as you know, the closer you get to retirement, you need to become a little bit more conservative. And again, what I go over with my clients is that we kind of break our clients' assets into two different tanks. We have a risk tank and we have a safe tank. The safe tank has money such as money markets, CDs, fixed annuities, fixed index annuities, cash value life insurance that earns a little bit of interest, but it can't lose money. And the risk tank, you have everything else. For example, your 401k or any kind of mutual funds or stocks or anything that could potentially lose value. So as we kind of get closer to retirement, we tend to be a little bit more conservative because we can't afford those big drawdowns. So, but we also have to address the issue of inflation in retirement. So again, we're going to talk a little bit about market risk, and we've got to make sure that whatever strategy that you're using, that you have a way to minimize those losses when the market drops. Okay, we're going to talk about tax risk and what you got to address. Again, how are you going to strategically position your assets in both the accumulation phase and the distribution phase? So one of the conversations that we have is that, how do you want your portfolio to look 5 or 10 years from now from an asset allocation point of view? So when you look at your overall portfolio, we tend to break that down into, cash or fixed income, like safe stuff. We have your moderate or your fixed incomes, maybe a bond portfolio, maybe a 40-60 or a 50-50 stock to bond portfolio. Then we may have more aggressive money or accounts that you may not touch for 10 years down the road. So we look at a portfolio from an asset allocation, from very conservative to fixed income to aggressive. But you also have to look at it from a tax point of view. You have taxable, tax deferred, and tax free. So you have to think strategically, well, how do you want to transition your portfolio into the distribution phase down the road to help minimize taxes in that distribution phase. So that tax risk is real, and we're going to talk a little bit more about that this evening. Okay, rising healthcare costs and long-term care costs. Again, where's the money going to come from? Okay, we know that you and I have a pretty good chance of needing care at some point in our lives. The question is, how are we going to pay for it? So we're going to be talking a little bit about that this evening. And we're also going to kind of talk about inflation. Again, I see all different types of people in terms of risk tolerance. We have super aggressive people, but I also see a lot of people who don't want to take any risk at all. And the problem is, and I just was listening to CNBC today, and they're talking about the Fed. So the Fed had their meeting, and the Fed is projected to keep interest rates exactly where they are for the next 4 years. So we're in a historically low period of time in terms of interest rates. So that means ultimately that the interest that we make in our savings account and CDs, the money markets, is very, very low, and it's not going to keep up with inflation. If you want to look at inflation, look at what you're spending on your grocery bill today versus a year ago. You're going to see that the cost of groceries are going up, and that's just one example. So we got to address inflation in retirement income planning. We also need to look at death. So if spouse A dies, will spouse B be able to maintain their standard of living? And the other question is that upon death, either if you're single, is legacy planning important to you? Or if you're married and one spouse dies upon the second death, is legacy planning important to you? Do you want more of your estate to flow to your family, or would you just don't care, and maybe it's okay if they get whatever they get, and Uncle Sam gets a big chunk? Okay, so these are things that we have to address when we're putting together a retirement income plan. Okay, all right, let's talk about Social Security for a minute. As I said, I give Social Security seminars very, very frequently. I got the next one coming up in a couple of weeks, but I only have a time to go and just do a couple different areas. So I'm just going to hit a couple topics. But again, if you haven't been to one of my Social Security web seminars, you definitely need to attend it to get a better picture of how it all works and fits into retirement income planning. So the question is, when does the filing decision typically happen? And what's amazing is that 44% of people who file for Social Security take it at age 62, which kind of blows me away. So again, less than 1 in 3 individuals file for their full benefits at full retirement age or later. And one thing that you're going to learn, I mean, you may already know this, but again, if you defer filing for your Social Security after your full retirement age, you get what we call DRCs, or delayed retirement credits, which means that your Social Security will increase about 8% per year for every year beyond your full retirement age up to age 70. So this is where a lot of Americans have been filing for Social Security. And what's amazing is that you can see the difference right here. So this is just an example. So I first need to explain what a term is. PIA stands for primary insurance amount. Okay, so the way that your Social Security, like the amount that you're going to get at your full retirement age, just to give you a bit of history behind that. What happens is that every year that you and I have earned income and contribute into the Social Security system, that counts towards Social Security. And what they do is that they take the top 35 years that you and I have contributed into the system. They apply a formula to address the cost of living adjustments, and then they come up with your PIA, or their private insurance amount. Okay, now again, I cover this in my Social Security workshop. You've got to have 40 quarters to be eligible, which basically equals to about 10 years of earned income to contribute into Social Security. So what we're doing right here in this example is that this person has a PIA of $1,000, because we can do the math really easy in this example. So if you take Social Security prior to your full retirement age, as early as age 62, you will take a 25% reduction in your benefit. So you can see on the screen right there. So, and again, that is a permanent reduction. And remember that Social Security has cost of living adjustments. So if you file for your Social Security at age 62, and let's say you could have had $1,000 at your full retirement age, but now you're getting 750, you're getting cost of living adjustments on the 750 amount, not the $1,000 amount. Okay. Now, however, if you file for your Social Security at your full retirement age, you will also do a couple little things. I kind of skipped over a thought right here. If you file for Social Security before your full retirement age, and you make over, it's roughly 18,000 some odd dollars, there is a threshold of income that if you hit, if you make over that dollar amount, there will be a reduction in your benefits. So for every $2 of income, $1 will be reduced. So anyway, there's a reduction not only in Social Security, but if you actually have earned income above that income threshold, there's also going to be an additional reduction of your Social Security. Now, again, if you wait till your full retirement age, there is no, you don't hit the income limitation. So you can make as much money as you want to and still receive Social Security with no reduction in your benefits. Now, let's say your full retirement age is age 66 and you wait to age 67. Okay, you're going to get an 8% increase on your Social Security benefits. So you receive $1,080. And you can defer your Social Security up to age 70, and that is a 32% difference. Now, the reason why we cap it off at 70 is that you could, in theory, file for Social Security after age 70, but there's no financial incentive to do that because the delayed retirement credits of that 8% a year are going to stop at age 70. So the latest that you want to file for Social Security is age 70. Okay, so when you kind of look at this, the difference is about a 76% difference between filing for Social Security at 62 and 70, plus the cost of living adjustments. So if you've got a cost of living adjustment on Social Security of, let's say, I'll make it up, 2%, I'd rather have a 2% COLA on $1,320 versus a 2% COLA on $750. Okay, so I just want you to kind of think about that. Now, there are some very legitimate reasons to file before your full retirement age. The main one that I see is that you may be underemployed or unemployed at age 62 and Social Security is your only source of income. Okay, take it. Okay, if that's your only source of income, then it may make sense for you to file for it at age 62. Another reason to file before your full retirement age is that, quite frankly, if you feel that your life expectancy is not that long and you're not going to live for, X amount of period of time, that would be a reason or an argument to possibly take Social Security sooner than later. Okay, if you're healthy and especially have a decent sized portfolio, that let's say you wanted to retire at age 65 and you had enough money in your portfolio that you could pull from that and wait to file for your Social Security to age 70, that might be a good strategy. Again, we don't know what your situation is, but there's different ways that you can kind of think about it. Okay, now let's talk about spousal benefits. So when we do Social Security planning, we can do more things for people who are married versus single. Okay, if you're single, you basically can choose when to file for Social Security, and that's about it. But if you have a spouse, there's some other strategies that we can use. So what this means is that if you have spouse A, male or female, it doesn't matter. So let's say spouse A has Social Security that's over twice the amount of spouse B. So if spouse B's Social Security is less than 50% of spouse A, they may be able to get a what we call a spousal benefit. And even if you don't qualify for Social Security, like you don't have your 40 quarters, you are entitled to spousal benefits whether you are, again, if you're married, you're entitled to a spousal benefit whether you have your 40 quarters or not. So that's also a very kind of positive thing. Now, here's just an example on how this works. Okay, this is just real simple. Spouse A's PIA is $2,400 a month. And if you look on the right side of your screen, the way that you do it is this, is that you take this, the spouse with a higher Social Security, you divide it by 2. So in this case, it's $2,400. Divide that by 2 is $1,200. Now, is that $1,200 greater than spouse B's PIA? In this example, it is. Spouse B's PIA is $1,000. That means that if you subtract half of spouse A's of $1,200, the extra is $200 that would go to the spouse. Okay, so spouse B would get her, Social Security 1,000 plus another $200 to get half of spouse A's. So when you add that together, you're going to have $2,400 plus another $1,200 for a total of $3,600. Okay, so that's how spousal benefits work on a simplistic basis. But guess what, guys? Spousal benefits can be very, very complex, and there's a lot of subtleties. Okay, so when it comes to Social Security planning, you need to talk to me or someone who is actually kind of a certified Social Security kind of planning person who actually knows the ins and outs of Social Security, because it gets complex, and what you don't know can literally cost you plenty. Okay, so here's an example of that. Spouse PIA is $3,000 and spouse B's PIA is $500. We're going to show extremes in this example. So what happens if spouse A says, listen, you know what? I don't want to take my Social Security at age 70. I want to get the maximum amount. So if spouse A takes their Social Security at age 70, that would increase to $3,900 a month. That's a big jump. But how do the spousal benefits work in this situation? So do you get half of the $3,900 or do you get half of the spouse's PIA? The answer is you get half the spouse's PIA. So if the PIA is $3,000 in this example, half of that is $1,500. So in this example, you take the $1,500 minus spouse B's PIA of $500. The spouse B gets an extra $1,000. Okay, at the end of the month, or at the end of the period of time, once spouse B has filed and gets his $3,900 a month, you have $3,900 plus the $1,500. That equals $5,460. Okay, so I just, this is, again, I go into more detail about this in the Social Security seminar, but this is just an example that sometimes, we see a wide disparity between one spouse's Social Security and the other. And this is just an example to kind of share with you how it works and how spousal benefits work and how important it is to actually know the rules of the game. Okay, so what happens if you're divorced? Okay, well, in order to receive divorce benefits, you've got to be married for 10 years. You've got to be divorced for at least 2. You've got to be at least 62 years old. You've got to be unmarried, and their PIA amount must be less than half of their former spouse's PIA. Okay, so that's an important thing. That last bullet point is key. If you know that your PIA is less than half of your divorced spouse, then it makes sense. If it doesn't, then that's a different story. And you probably just, then we look at taking yours versus taking a divorced spouse's. Okay. The divorced spouse must be entitled, which means they are entitled to file for Social Security, and that's at least age 62. Okay. They do not have to file for Social Security, but they have to be entitled to file for Social Security. So by the way, if you file for divorced spousal Social Security benefits, it does not affect the amount of Social Security that they receive. You're just kind of tagging on to theirs. But if if you talk to them and find out what their PIA is, and they think, well, I don't want you to take it because mine's going to be reduced. That is not the case. Okay, and you can look on the Social Security website to kind of verify that. Okay, now, so if the independently entitled divorced spouse files before full retirement age, benefits will be permanently reduced at FRA, or later if they receive only half their former spouse's PIA. So the point is just I want you to kind of think about it, that if you file before your full retirement age, in all scenarios, your Social Security is going to be permanently reduced. Now, if you're in a situation where you're divorced, your PIA is less than half of your ex-spouse, and your ex-spouse is deceased, well, where does that leave you? What are your options? Well, I've had that case twice with people who've attended my Social Security seminars. So for you to file for divorce spousal survivor benefits, you had to be married for 10 years, divorced for at least 2. You've got to be at least 60 versus 62, or 50 and disabled. You cannot remarry before age 60. And again, if the person filing for divorce, if the person filing for divorce survivor benefits files before FRA, the benefits will be reduced by at least 30%. Okay, so again, there's actual tables that we apply for this. So you got to know the rules, and again, this is something that we would kind of talk about to kind of figure out what makes sense for you. So we look at it. So I just want to give you an example on how this kind of stuff works. So here's an example of a female independently entitled divorced spouse, age 60. She's unemployed, and her FRA is age 66. Her PIA is at 2,400, and her ex-husband, who died 5 years ago and never filed for Social Security, also has a PIA of $2,400. Okay, so what would you do in this situation? Is that you're not employed. This is the only income that you have. Your portfolio may not be so big. What would you do? Well, most people say, I'm just going to kind of file, as soon as I can and get what I can. So one thing that she could do is wait 2 years, because remember, you can't file for your own benefits until the earliest at age 62. You're going to receive a 25% reduction, and she would receive about $1,800. That's option 1. Option 2 is that she could file for divorce survivor benefits now at age 60. She would receive $1,716. She could then take her Social Security of $2,400 once she reached her full retirement age. That's pretty cool. So in this case, she could file for divorce spousal benefits, receive $1,716 a month from 60 to 66, 6 years, then turn on her Social Security at age 66, which would be $2,400 a month. That would give her a considerable increase versus her waiting 2 years and starting at age 62. But there's a third option. What she could do is file for divorce survivor benefits now at age 60 and receive the $1,716, just like we showed in the last example. But you know what? She doesn't have to take her full Social Security at her full Social Security age. She could defer her benefits until age 70, receive the delayed retirement credits, and receive $3,168. All right. So again, this is just an example where you've got to understand the rules. And if you don't understand the rules, you could literally be leaving tens, if not hundreds of thousands of dollars on the table. And we don't want that. All right. So that's my little, thing about Social Security. I'm moving on. Okay, investments and risk. Okay, this is a big topic everybody wants to know about. So let's just kind of look about where we are today versus your parents or grandparents. Okay, in the generations before us, many of our parents and grandparents had a pension. They also had Social Security, and therefore their nest egg needed to be a much smaller amount of money. Well, now, that triangle is inverted, and fewer people have pension plans. We'll all have Social Security for the most part, but that means that you and I are more responsible to build our portfolio large enough to kind of maintain our standard of living, because most of us don't have a pension plan. And just to kind of give you some statistics, again, this is the number of private sector plans between 1975 and 2016. So the slide's a little old, but still the point is that it hasn't changed. There are far fewer pension plans today than there were back in 1975. Okay, so it just kind of shows you that many people do not have a pension plan. So this is important that you are responsible for your own portfolio, and that's why we have 401ks and so forth. And you got to make sure that that money is managed properly, not only in the accumulation phase but in the distribution phase. All right, and here's the reason why. In the accumulation phase, we've had bear markets. I'm going to talk about those in a minute. We just had a bear market in March of 2020, where the market dropped over 30% in 4 weeks. That has never happened in US history. Okay. Fortunately, it recovered. So let's kind of think about that. If you had a $100,000 portfolio and it dropped 30%, and let's say your portfolio was all in the S&P 500, for example. Okay, I gotta be intellectually honest right here. So if you had all your money at the S&P 500, or let's say the total U.S. stock market, and it dropped 30%, your $100,000 portfolio just turned into a $70,000 portfolio, and you would need almost a 43% rate of return just to get to the break even of that 100,000. So what if you actually added a zero to that portfolio value? Let's say you had $1 million portfolio, it lost 30%. Your $1 million portfolio just dropped $300,000 from $1 million down to $700,000. That's a little scary. That's real money. And so the more that you lose, the higher percentage rate of return you need to get to break even. And the problem is, or the challenge is that in retirement, when you're taking distributions out of your account, you can't afford to have those losses because it takes so long to get to the break even. Okay, so I'm going to talk about 3 different ways of pulling money out of your accounts in just a minute, but I want you to really kind of internalize this situation. Now, I talked about a 30% pullback of March of 2000. What happens if you look at a bear market recession where it goes on for years, like it did from 2000, 2003, or 2008, where the market was down roughly 50%? There, boom, your $100,000 portfolio is down to 50,000. Your $1 million portfolio is down to 500,000. Your $2 million portfolio is down to $1 million. So the problem is that you need a 100% rate of return just to break even. Okay, so this is a super important concept, and this is why you got to have good money management. That's why your portfolio's got to be appropriate to your situation. Okay, there's a thing called a black swan event, and all that is an event or an occurrence that deviates beyond what is normally expected of a situation and is extremely difficult to predict. Okay, so I'd be willing to bet a fair amount of money that everyone listening to this webinar right now could not conceive of the coronavirus happening and the entire world economy shutting down in such a short period of time. So think about it. In January, in the first couple weeks, well, just think about in January. We kind of heard a little stuff in the news sort of late January, but could this stuff really happen to me? Yes. So this was a black swan event with the coronavirus. The other thing is that, remember, at the same time, we saw an oil war, price war between Russia, the Middle East, and also the U.S. was kind of thrown in there. So it was basically supply and demand. So we actually got hit with a double whammy with this last black swan event, both with the COVID-19 and also the oil wars of supply and demand. So there's a big glut on the oil market. Okay, that's a perfect example. Okay, now here's the deal, guys. You cannot prevent a black swan event, but what you can do is that you can construct a portfolio that will minimize losses and continue consistent income regardless of what the stock markets and bond markets do. Now, wouldn't that be nice? That I wake up on New Year's Day every single year of retirement and I know that I've got consistent income coming into my checking account every single month like clockwork. And what that allows us to do is that when we have these bear markets, when we have these black swan events, which we will have in the future, at least our income is not affected. Okay, and we can pay our mortgage, we can pay all of our bills, and maybe go on a vacation and have some fun times with our family. Okay, so our portfolios, the way that they're designed, are extremely important. They're important in the accumulation phase. It's even more important in the distribution phase. Okay, just a little bit about bear markets. Again, they're defined as a 20% decline or greater in the S&P 500. We've had 16 since the Great Depression. They average about 5.5 years. They average the negative 38. They last about 17 months. That's the average. Remember, the one from 2000 to 2003 lasted about 2.5 to 3 years. So again, it lasts about 1.5 years on average. Okay. So again, the average time lost making up a bear market is roughly 5 months. That is actually the average period of time to crawl out of the hole and get back to the break even. That's roughly 5 years. Okay. That's why we can't afford to take losses in the first place. And just to kind of show you visually, here they are. Those are the 16 bear market recessions, the duration, the decline, and the time to break even. So those are the statistics, folks. And again, the source is the S&P 500. You can look it up. So this is serious. Now, we thought that this bear market in March of 2020 could have been bear market number 17. Technically, it was a bear market, but it was not a bear market recession. Okay. Nevertheless, it was very, very painful and scary. And this is what it looks like in real time. The market had more or less a V-shaped recovery in this year, just a few months ago. But this is what a bear market looks like. This is more typical. So you can see on the left side of your screen that the S&P peaked on October the 10th, 2007, and it kind of dropped. Now, if you look at the first month or so, that's kind of what the market looked like right now. We had a little bit of a pullback, but it's not that big a deal. That blue line is what we call the 4-week exponential moving average, and the yellow line or the orange line is the 40-week exponential moving average. So basically, they're just moving averages. And what we've from a technical analysis point of view, when the shorter moving averages cross the longer term moving average, that is a bearish sign. So you can see that the blue crossed the orange, it kind of bumped up a little bit and then dropped. It had a little bit of rally in kind of May and June of 2008, and then after that point, it just kind of dropped. And so you can see that in November of 2008, it just dropped. There's a little bit of optimism when Barack Obama got elected president, but that wasn't it. The market continued to drop for another couple months. And again, from peak to trough, that was roughly a 57% decline in the S&P 500. We all lived through it. And so, and that caused devastation. And what that really did was that for all those people kind of in your shoes that wanted to retire, all of a sudden their portfolios dropped 50%, and that just kind of made them work a much, much longer period of time. And they couldn't retire when they wanted to because they had to make up for those losses of the market. And that happened to the average American who really wasn't watching it and was just kind of told to buy and hold. Oh, that's okay, just buy and hold and invest money for the long term. You'll be okay. Well, the problem was it wasn't okay. And so you've got to have a strategy with your investments in both the accumulation phase and as well as the distribution phase. Now, kind of finishing this slide up, you can see that the blue line started to go up, and the blue line kind of touched the orange. It dropped back a little bit, then crossed again. And again, when it hit the second time, that was an absolute buy signal to get back in the market, or we knew that things were kind of on the right footing at that point. So what I kind of showed you right there were two things. I showed you kind of the anatomy of a bear market, that it typically doesn't happen like drops like a rock. It typically kind of falls over a period of time. The second thing is that I kind of introduced you a little bit to what we call technical analysis, which is kind of looking at charts to determine where the markets are going, or should you be on offense, should you be on defense. Okay. All right. So when this happens, okay, I'm going to talk about sequence of return risk. Now, here's an important fact. There is a window of time in your life where your finances is the most important. That window is the 5 years prior to when you retire and the first 5 years when you do retire. So if you look at your life expectancy from a newborn to when you're well into your 70s, 80s, and 90s and pass away, the most important 10-year period is the 5 years before you retire and the first 5 years in retirement. And this is the reason why. I just showed you that bear market recession slide, okay? Now, what happens is with sequence, again, in the accumulation phase, if you took a 20-year segment of the S&P 500, you've got up years, you got down years. At the end of that period of time, you're going to have an average return. And, it's going to be roughly, 5.6% if you look at 2000 to 2019 or 2020. Okay. In the accumulation phase, it doesn't matter. But what it does matter is in the distribution phase. So if you retire into that 2000 to 2003 time frame, which could absolutely happen, it's going to have an enormous impact on your portfolio ripple effect for decades to come. Okay, so again, people who experience even 1 year of a market loss early in their retirement may need to make significant adjustments to their plans. Conversely, the same loss later in retirement will likely have a much less of an impact on one's retirement income or lifestyle. The problem is that you and I do not know exactly where we will be in the economic cycle when we actually retire. And that is an absolute risk. Okay, so that's what we call sequence return risk. So I'm just going to show you on the left. So here's an example where you have $100,000. You're going to take out 4%, and that's $4,000. We're going to increase that by 1.5% each year for inflation, and we're going to assume that you're invested in the S&P 500. So what you're going to see right here is that in that first year, the SP was down 10.14%. So you're at $100,000 minus your $4,000 distribution. At the end of the year, it's going to land at $86,265. Next year, the SP is down 13%. Got to pull out $4,060 to keep with that 1.5% inflation. The value of your portfolio at the end of the year is $71,485. Third year, and here's the equivalent to 2002. The SP was down over 23%. Your IRA value is a little over $51,621. Now, the fourth year, we had a good recovery year. The market was up 26.38%. And now we had the portfolio starting to climb again, even with that distribution. So if you look at the bottom of the screen on the left, the average return over that 20-year period was 5.6%. And the IRA value at the end of that time was $8,742. And you took a total of $92,495 of distributions. Okay. Now, if you look at the right scenario, the only thing that we changed was the first year that you retired, we had an up year. We had 28.88%, which is what we had in 2019. So your $100,000 with your $4,000 distribution actually increased because we had a phenomenal year in the stock market. It actually ended up at $123,724. The next year was down a little bit, but the portfolio still landed north of 112. Fast forward to the bottom, your IRA balance is over $120,000 opposed to $8,700 in the other example, and you still took out the same amount of money. Okay, what this is illustrating, folks, is what could happen in different market cycles. So my point is that you need to make sure you have a strategy that if this happens, and there's a reasonable chance it will, that your portfolio is going to survive and it's not going to be completely eaten up by market losses and distributions. Super important concept. Okay. So again, which strategy is best for you? So many of the people, if you're listening to this call, the chances are you are a buy and hold investor. That's what they told you to do. Listen, put your money into a target date fund or an asset allocation fund in your 401k or in your TSP, and you'll be fine. You may be in a 2030 fund, you may be in a 2020 fund or 2040, whatever. That's the path of least resistance. The question is that the best place for you to be in a bear market recession? So my question to you is, if you've got an asset allocation fund that's in 60% stocks and 40% bonds, will that guarantee you that you're not going to lose money? Absolutely not. You got 60% of that 60-40 portfolio with the stock market that can lose 50%. So you have to understand that just because you have your money in a target date fund or some asset allocation fund, that there's no guarantee you're not going to lose money. The chances are you will. Okay. Now the other thing is that if you're, especially there's a lot of federal employees, so I'm just going to use this. So the federal employees in their TSP have their G fund. It's the guaranteed fund. So what happens is that people say, okay, fine, I'm going to move all my money to the G fund. Great. That's great in a falling market. The question is, when are you going to get back in? And I can tell you, because I talked to lots of people, here we are in September 2020, there's still a bunch of people who I talked to who got defensive back in the beginning of the year in March, the market was dropping, and they're still in fixed accounts. They haven't gotten back to the market, and they just missed out on a huge return because the stock market today is greater than where it was when it first started to drop in mid-February. Okay, so what I'm telling you is that the target date and asset allocation funds can be an okay place. It's not the best place for you to be in the accumulation phase. It's definitely not the best place to be in the distribution phase. Okay. There are also robo-advisors, which is basically taking the same kind of concept, but they're going to put together a portfolio of a bunch of ETFs. Wealthfront, Betterment, Schwab portfolio. I mean, there's all these different companies that are doing that kind of stuff. It's basically the same thing. They're just putting together their own portfolio with ETFs for the most part. Another investment strategy is what we call active or tactical management. That's what we do at our firm. And what that allows us to do is that we're able to take advantage of sectors that are actually beating the S&P 500 and also underweight sectors that are underperforming the S&P 500. Allows us to also be more aggressive when the markets are really going forward, and allows us to be more defensive when the markets are pulling back and we need to be defensive. So our investment philosophy is to be more active and tactical with our money management. That's just a personal way, but again, my personal money is managed that way. You may be a day trader or a swing trader. If you're on the call and you're buying and selling stocks, that's certainly one way of doing it. What I find is that if you're really good at day trading or swing trading, you're probably retired already because you don't have the time to do it. So there's a huge learning curve with day trading. You can make money at it, but you're also going to be tied to your computer for many hours a day if you're going to do it well and actually really make money. So the question is that how you want to spend your day while you're retired, or is that, or do you have time to do that while you're working? Probably the answer is no. So for most of you guys on the call, you're probably not traders in that regard. One of the options that you have are annuities, and we use annuities a lot in retirement income planning to act as shock absorbers, or what we call portfolio buffers. And we also use income annuities to provide a guaranteed income stream. Again, the word annuity and pension can be interchangeable. So, annuities have in some circles have gotten some bad press, but the more that you learn about this particular tool, the more you see how valuable it can be to do certain things in your portfolio. So we use annuities a lot in various parts of the portfolio. The other thing, though, some of the options that you have are alternative investments. Some of you might have rental properties, either residential or commercial. There's private equity, hedge funds, private loans, commodities, managed futures, energy, those sorts of things. Um, I have access to most of that stuff, and we can certainly do it. I've kind of gotten away from it over the years because I quite frankly feel that there are better ways to manage risk, but all that stuff is available if you want to. So you on the call, you're going to kind of gravitate towards an investment philosophy that makes sense for you. My job as an advisor is to understand what you're trying to accomplish and say, hey, these are different tools in the toolbox that you may want to consider to do these specific things very, very well. So the investment strategy is going to be dependent on you, what you feel comfortable with, but it's also going to vary between the accumulation phase and the distribution phase. As I said, one of the biggest mistakes that people make is using the same investment strategy that they use to grow their money in the distribution phase in retirement. Don't make that mistake. And again, we can talk about that a little more and I can give you some insight on that. Okay, so let's talk about 3 retirement withdrawal strategies. One is that most people just think about, hey, listen, I'm just going to take withdrawals from my portfolio when I'm going to do so. So that's the probability based. So again, the probability based is an investment centric kind of concept that I'm just going to pull money out of the portfolio. I feel that stocks are going to outperform bonds over the long term, even if we have some volatility. So again, most people by default kind of take the probability based. The problem with the probability based is that there's no guarantee that your portfolio is going to hold up. There's no guarantee that it's going to last forever. There's no and the question is that it's not necessarily the best way to approach sequence of return risk. Okay, so there are a bunch of disadvantages to the probability base that we can kind of go over at another point. Second one is what we call the safety first approach. This concept, so that the person, in contrast to the probability based, feels that, listen, in retirement, I don't care so much about getting the greatest rate of return. What's important to me is to make sure that I've got consistent income coming in to meet my retirement needs. Okay, so it's a different mindset. So the safety first approach, that investor says, listen, I feel that my portfolio that's going to have stocks and bonds is too risky, and I feel more comfortable having guaranteed sources. So the safety first approach is where you have, let's say you need X amount of dollars, you got Social Security, you may have your pension. How are you going to fill that gap? You fill that gap with guaranteed sources. Those guaranteed sources are going to be Social Security, potentially a pension, or an income annuity from an insurance company. Remember, a pension and annuity, they're doing the exact same thing. They're spreading risk over hundreds of thousands, if not millions of lives. They're using actuarial tables to determine how much to pay out over a period of time. Okay. Now, another option is that we have what we call the 3-bucket strategy. And that's where we actually break down your entire portfolio into 3 buckets: conservative, moderate, and aggressive. And here's the idea. So we know that the markets are going to go drop. So if you had, let's say, 1 year or 1 to 3 years of your living expenses literally in cash or bonds or some very, very conservative investment, when you need money to literally pay the bills, you take a distribution out of your conservative account. What that does is that allows you to not take distributions out of your moderate account or the aggressive account and lock in losses when the markets drop. It allows you that time for that portfolio to come back up so you don't have to take those big losses. So we divide up the portfolio into conservative, moderate, and aggressive, and that's how we do that strategy right there. So again, sometimes a combination of 2 of these makes more sense. What I've learned from experience is that taking that safety first approach and layering the 3-bucket strategy on top of that can be a very, very effective way to manage risk in your portfolio. Again, just something to think about. All right, let's move on to retirement taxes. I got to try to keep this tight here. Okay, first of all, this is a great website. Go to usdebtclock.org, and this was a snapshot as of September the 15th, 2020. And you can see at the top that the national debt is over $26 trillion. Okay, where the largest budget items are Medicare, Medicaid, Social Security, Defense, and War. And so the bottom line is that in order to pay for the deficit, they've got to raise taxes. So, and here you go. So if you are taking money out of your 401ks, again, there's three different tax baskets. There's taxable, tax deferred, and tax free. If you're taking money out of your qualified accounts or your tax deferred accounts that you never paid taxes on, and you had a $500,000 portfolio, and let's say you're in a 30% effective tax bracket, you keep 350, the IRS is about 150. Okay, so this is kind of an oversimplification of that because there's a marginal tax bracket and all that kind of stuff. I get it. This is just to illustrate a point. The IRS is going to take a big chunk of that money, and if taxes go up, that's going to be less money in your pocket. Okay, so a couple little things to do. So the Secure Act came out, and again, I've got a lot more information on this if you want it, but here's the main thing that affects you and your beneficiaries. If you've got an IRA or a 401k or any kind of qualified account that you got that went in pre-tax and you never paid taxes on it, what happens when that person dies and it goes on to a non-spousal beneficiary? Okay, so the old rule is that if you have a non-spousal beneficiary, that your son or daughter, or some other person who's not the spouse, could actually take distributions over their life expectancy. They're able to stretch out those those distributions over the course of their life. That rule is gone, done. The new rule is the 10-year rule, which basically says, so if you died today and your children inherited your IRA account, what would happen is that they would open up an inherited IRA account. That money would transfer from your IRA or 401k to their inherited IRA account. And at that point, when the money hits the account, that 10-year stopwatch starts. So all the money in the IRA must be withdrawn by the end of the 10th year, following the year of inheritance. Okay, the beneficiary does not have to take withdrawals during the 10-year period if he or she doesn't want to. But if they wait until the last minute, they could have a big tax bill. So if you inherited $100,000, now that $100,000 grew to $200,000, and you got to take it all at once. Remember, that's a huge tax bill because that distribution that you got to take as the beneficiary, that is ordinary income that gets added to your ordinary taxes. Okay, so that could be a huge tax bill. Okay, so again, deciding when to take the withdrawal should be based on several factors, including the beneficiary's current financial situation, how close they are to retirement, and when they plan on taking the Social Security benefits. Okay, so this is where some of the tax planning comes into play. Okay, now there are some exceptions to the 10-year rule. The spousal inheritance rules have not changed. So spouses may still re-register the IRA into their own name, or leave the IRA in the name of the deceased spouse and take out RMDs using their life expectancy. For minor children, so if a child who's a minor inherits that account, the 10-year rule starts once the child reaches the age of majority. So that's one nice little thing. Okay. The other question is about legacy planning. So I'll give you an example right here. So Judy, who is single with 2 children, has a $500,000 total in her qualified accounts. Her children are grown, financially stable, and they don't need Judy's inheritance to support their lifestyle. Right? So Judy is concerned that taxes will go up, and she wants to pay as little in taxes in retirement and pass on as much of her estate as possible to her children. Again, what are some of the strategies to potentially minimize the taxes and pass more of Judy's estate to her children? So remember, her children are grown, they don't want the money, and she wants to pass more of her estate to her children so they get more and the IRS and the government gets less. What are some choices? Well, the first thing that comes to mind are obviously the Roth IRA conversions. You can see the new rates on the left versus the old rates on the right. Just remember, when the new rates went into effect, there was a 10-year sunset provision. So if Congress doesn't vote on them to keep the tax laws exactly where they are, they automatically revert back to where they were in 2017. So if you look at the tax brackets, you can kind of see the difference right there. Again, I can get you the slides so you can kind of look at this stuff. So right now in 2020, 2021, this is an excellent time to consider Roth IRA conversions. Again, we can talk to you about that, but this is something that we would actually talk to you and your accountant about to make sure that we get the timing and the amount correct. But Roth IRA conversions are really important because what happens when your beneficiaries inherit a Roth IRA versus a traditional IRA? They still have that 10-year rule still applies, and they still have to deplete that account. The main difference is that they do not have to pay taxes on the Roth IRA distributions when they take that money out. What they do when they take the money out, they're either going to spend it or they have to invest that money into a taxable account. So again, they're paying, you know, tax potentially twice on it, because again, you're either going to spend it, or if you take out money from a Roth, you're going to invest it, it's got to be in a taxable account. You can't take Roth IRA contributions or distributions and put it into a Roth IRA unless you have earned income. So you know, this is one of the issues that you have. So Roth IRA conversions, it can be a really smart thing to do, but obviously that's a conversation to have. The other option is that people think of life insurance as strictly as death benefit, but the more you understand about life insurance, you realize how powerful of a tool it really is. So I want you to think about this. So let's say you were fortunate that your portfolio was large enough that when you had to take your required minimum distributions when you turn age 72, that the amount that you had to take out of your account exceeded the amount that you need to live on. Therefore, what I'm saying is that your account value is large enough that when you take your required minimum distributions, you're required to pay tax on those distributions on money that you wouldn't need otherwise. So you basically have to take that money and either spend it or invest that into a taxable account and effectively pay tax on it twice. We want you to pay taxes on it once. So here's a concept. So this was an example where the family decided, listen, I'm going to gift my child, or it could be children, it doesn't matter, $15,000 a year over a 10-year period for a total of $150,000. This is just an example. You could do any amount you want. What they did was, let's say their child was 40 years old. They actually bought a life insurance policy, a whole life policy on their son or daughter who's, let's say, 40 years old in this case. They minimized the death benefit to maximize the amount of premium. The amount of premium that went into the policy maximized the cash value. So we wanted to have as little of the premium go to pay for death benefit as possible. But you can decide any way you want to. So basically what we showed right here is that at $15,000 a year, that bought $469,000 of death benefit that could go to your son or daughter's, you know, family. So they contributed $150,000 over 10 years. And what happened is that they took distributions from the IRA account, or it could come from a non-qualified account as well. They gifted that $15,000 a year. What happens? That $15,000 grows in the cash value. So the death benefit increased to over, you know, $864,000 between age 40 and age 70. And the cash value also grew to over $468,000. So again, why we do this? We want to build the cash value of the life insurance policy. So what are the characteristics of the cash value life insurance? One is that it's going to protect your principal. You're not subject to market loss. The second thing is that money comes, if you take loans and withdrawals out of the cash value, there's no taxes on that. If you want to borrow money from your policy, let's say to buy a car, if you want to finance your car instead of going to a bank and borrowing money for a car loan, you could take money out of your life insurance policy, take the check, buy your car, and instead of paying the money back to the bank, you just pay the money back to the insurance company. It's a way that you can become your own bank. So in that cash value life insurance, there's no penalties to have access to your money. There's no requirement of distributions. There's no market risk. And there's also money that you can tap into if you have a health issue. You can also buy a rider on that policy that potentially, if you can't do 2 out of 6 activities of daily living, you could actually use that to help pay for long-term care costs. And the main thing is that the distributions from that policy, assuming that you set up correctly, will come out tax-free. So this is a case where that $150,000 that the parents gave to the kids between age 70 and 84 in this example, they took out over $40,000 a year tax-free over 15 years, which totaled over $604,000. And also, they also had, a death benefit. So my point to this is that, again, I'm hitting this concept very fast, but one of the best ways to transfer wealth from your generation to your children is through life insurance. Okay, this is one of many, many examples that we have, but I just want to kind of introduce you to this concept. Okay, so anyway, I'm moving on because I'm trying to wrap things up. All right, retirement and healthcare. Here's some statistics about healthcare. Again, someone turning age 65 today has a 70% chance of needing some type of long-term care services in the remaining years of life. Okay, the typical time that we need is between 1 and 3 years. Again, over 15% of retirees at 65 or older will spend over $250,000 or more on long-term care expenses. And again, the thing is that the number of insurance companies that offer this insurance is continued kind of dwindle down. In 2018, we had about 15. There's actually about a half a dozen that I kind of deal with. So the average annual premium for the long-term care policy was just about $3,500 in 2018. Okay, so again, I'm not trying to pitch you long-term care insurance. I'm just trying to show you or kind of make you understand that there are costs involved, and this is just one way to kind of pay for the cost. So Genworth has a great website, and again, this is the website that you can go to right here. And the bottom line is that if you go to it, you can type in your zip code. I typed in Rockville, Maryland, so 20850, and you can see in the Washington, D.C. area. And again, I also want to calculate the future cost. So what's it going to cost me 20 years down the road? Well, if you look to the right of your screen, you're going to see a nursing home private room today on average is over $11,000. 20 years from now, just with a 3% cost of living adjustment, it's over $20,000. Okay, so my point is that these are the costs that you and I face here in this area. The question that you have to ask yourself is that how are you going to pay for them? Okay, you're either going to self-insure, and that money is going to come out of your pocket, or you're going to put some of that risk on an insurance company. Okay, so let me just kind of go back to this. So you're either going to self-insure, you're going to reinsure, or you're going to spend all your assets down and try to apply for Medicaid, which you may or may not qualify for that. Those are your 3 options. So what we do is that there are a number of different ways that we can help our clients kind of leverage the dollars that they set aside for long-term care expenses and still have access to them if they don't need them. They don't ever need long-term care. Okay, so I'm just going to kind of recap things. So I've covered a lot of information. I'm going to try to keep things reasonably short. So let's kind of recap what we covered right here. So one is that we kind of talked about the risk that we addressed in retirement. We talked about longevity risk, about not outliving your money. That's a huge risk that people don't really consider as much as they should. We talked about market risk. Again, the minimizing losses and maintaining a steady stream of income. We talked about tax risk, about taxes going up. And the question is how do you want to have your portfolio positioned at this point to put yourself in the best position? Rising healthcare costs and long-term care costs. Where's that money going to come from to pay for these costs? Inflation. Again, I've talked to a number of people recently that they don't like to take any losses at all. So they put all their money in either CDs, cash, or fixed annuities. And the problem is that they're not keeping up with inflation. So how can we keep up with inflation and also minimize risk at the same time? That's a key question. Other thing, upon death, what happens when spouse A dies? Will spouse B be able to maintain their standard of living? And how important is it for you to leave a legacy? So that's basically what we talked about tonight. Again, we talked about Social Security being complex. And the reason why I'm just bringing this up again is that you really have to understand the rules for Social Security. It is very complex. And by not talking to someone like me or someone who specializes in Social Security retirement income planning, you could literally leave tens of thousands of dollars on the table by making a mistake. I'm more concerned about what I don't know than what I do know. And that's especially the case when it comes to Social Security. You should be more concerned about what you don't know than what you do know. Okay? So again, this is just an example about just understanding how the rules work, that you could end up with a whole lot more money. The other thing about investments and risks. My question to you is, what is your plan to protect your principal if the first years in retirement are in a bear market recession? Just like we showed in the sequence of return risk. What is the plan? If your plan is to keep your money in the target date fund in your 401k or the TSP, I got some news for you. That's not the best plan. Okay, so we've got to really kind of talk about there's much better ways to address that when that happens. Second thing is that the investment strategies you use while working in the accumulation phase don't work as well in the distribution phase. So you need to come up with a strategy that works in the distribution phase. Also, leaving money in your 401k or TSP could end up putting you in a difficult position financially if you don't have a strategy to address market risk and sequence of return risk and longevity inflation risk. Okay, so again, the problem with leaving your money in the old retirement plans is that no one's being proactive to tell you what to do when different market cycles happen. You're relying on yourself. Okay, so that is an issue that you've got to address. Okay, we also talked about the 3 withdrawal strategies. The probability base, taking distributions from your portfolio. By the way, the probability base is the most risky way of taking retirement income money out. Number 2, the safety first approach, where we fill that retirement income gap with guaranteed sources. Okay, that's going to be the safest way to do it. That's how personally I prefer. That's how I'm going to have my own plan set up when I retire. The other way is that we have the 3 bucket strategy, where we break down our investments into a conservative, moderate, and aggressive accounts, and we kind of fill that gap with those types of things. Finally, taxes. Do you believe our taxes are going to go up or go down? I feel that they're going to go up. Where's your money going to be invested today? Okay, is your money right now going into your 401k and in the qualified accounts? Remember that current year tax deduction today is great on the accumulation phase, but if taxes go up and you got to take money out in the future, then you're going to have less money in your pocket. So it may make sense to put money into the Roth IRA, the Roth 401k, or maybe a taxable. Again, where's your money going today? You've got this little window of time that you have to make sure that you're set up properly the best you can in the distribution phase. Okay, how do you want your portfolio to look like from an asset allocation and a tax allocation point of view? This is one of the things that we talk about in our meetings with my clients, is that how are we going to structure your portfolio to make sure that it suits your risk tolerance and also minimizes your taxes. And is leaving a legacy to your family important to you? If so, would you rather burden them with paying the tax on qualified money coming out of your IRAs, or would you rather help them pay the tax so more of your estate goes to your family and less goes to the government and taxes? That's an answer that only you can answer. But if you would like to have more of your estate flow to your family and not burden them as much with taxes, that's a conversation that we should have. Okay, long-term care. Again, the chances are that you and I will need some sort of long-term care at some point in the future. There's 3 choices. You're either going to self-insure, you're either going to buy insurance, or you're going to spend down your assets and apply for Medicaid. Okay, there's your 3 choices. I just want you to think about it. If you're going to take the self-insured rate and most of your money is in qualified plans, if you take out $10,000, what are you going to net? You may only net $6, $7, $8,000 net after taxes. So that's going to deplete your qualified accounts even more. Okay. And by not making a decision, you're actually making a decision to self-insure, okay, which could be problematic. There's a huge opportunity cost. There's a bunch of different ways that we can kind of show people to kind of leverage their dollars to help pay for that and still have access to the money. Next steps, okay. Here's the deal. I've covered a lot of information tonight. So here's my call to action. Schedule a 15-minute call. You tell me what you want to talk about. Is it about the investments? Is it retirement income distribution strategies? Is it long-term care? Is it minimizing taxes? Is it you just feel like you don't have enough money? Let's just set up a 15-minute call. There's no obligation. You're not committing to an hour or two. You're not required to do anything. So my suggestion is, the link right there is, again, calendly.com/Jim Musgrave/15 minutes. That's literally a 15-minute phone call. So, in that call, if you would like some information for me to provide, I can do it. If you want to schedule another meeting where we start to kind of dive into that and you want to kind of look a little bit more into some of the things that we can do to help you, we can do that. It's up to you. So anyway, I'm going to kind of end the presentation on that note. I want to thank you for joining us. Hopefully I threw some great information at you, and hopefully I got you thinking about things that you need to be thinking about when it comes to retirement planning. So again, go ahead and schedule that 15-minute call at your convenience. And in the meantime, listen, I hope you guys are doing well and you stay safe. And we look forward to talking to you soon. So listen, I'm going to sign off. You guys have a good day, and we'll talk to you later. Take care now.